Good morning, or good afternoon, depending on where you are and when you're pressing play.
Welcome back.
It is Tuesday, February 10th, 2026, and you are listening to The Deep Dive. I'm your host.
And I'm your expert for today's session.
Usually we take a really broad topic, something like the history of coffee or the mechanics of quantum computing, and we just tear it apart.
But today is different.
Today's very different. We are going to be laser focused on the here and now. This is the Yieldera News Review Analysis.
That's right. We are stepping away from the abstract and looking directly at the pavement. We're analyzing the business week that just wrapped up.
Specifically, that window between the 1st and the 10th of February 2026.
Exactly. We've taken the top 7 news items reported by the major networks here in Ghana, and we're going to perform a kind of autopsy on them.
An autopsy? That sounds a little bit morbid for a Tuesday morning.
Well, maybe.
I prefer to think of it as a strategic debrief. Look, if you're a regulator, if you're an investor, or you're running a business here in Accra, you are just drowning in headlines.
Oh, constantly.
You get the push notifications, you see the tickers, but do you actually know what it all means for your Q1 strategy, for your bottom line?
Probably not, and that's the mission today. We aren't just reading the news, we are connecting the dots.
Connecting the dots between market performance, legislative gaps, these big macro trends, and, of course, the social reality on the ground.
It's all linked.
Before we jump into the deep end, though, we absolutely need to acknowledge the partners who make this analysis possible. This review is by courtesy of the Yieldera Policy Institute.
And it is proudly sponsored by Metis Decisions Limited.
And for those in our audience who manage risk for a living, and let's be honest, who doesn't these days, you probably already know Metis Decisions.
Oh, absolutely. They're a strategy and governance consulting firm based right here in Accra.
They are the folks you call when you need to tighten the ship. And looking at their service list, it is not just fluffy strategy talk.
No, not at all. This is the hard technical work. They design ICAP and stress testing programs, for example.
Which, let's be honest, in a volatile market like ours, that isn't just a regulatory box to tick.
No, it's a survival mechanism. It really is. They also handle board evaluation, enterprise risk management systems design.
And they build custom anti-money laundering or AML risk assessment tools.
Very important stuff.
Basically, they're like the digital immune system for your business. If you want to optimize governance or figure out if your bank can actually survive a shock, you go to Metis Decisions.
You can find them at metisdecisions.com.
Or email them at info@metisdecisions.com. Okay, bills paid. Let's get to it. Let's look at the board. What's the vibe of February 2026?
It is a study in contrasts. It really is. If I
Yeah.
only showed you the financial pages, you would think Ghana is in the middle of a golden age. Capital markets are surging, returns are incredibly high. But then if I show you the social data, the food on the table, or maybe the lack thereof, it's a crisis.
So it's a narrative of high growth, high stakes.
Exactly. That's the perfect way to put it. We see a Ghana that is surging in capital markets and GDP growth, yet it's facing these really deep structural bottlenecks in its legal frameworks.
And at the same time, significant social challenges, especially around food security.
It's a very complex picture, so I think we need to take it piece by piece.
Agreed. Let's start with the money. News item number 1. As of last week, February 2, 2026, the Ghana Stock Exchange, the GSE, has operationalized a new set of listing rules for the equity market.
And this is a really significant pivot. These new rules replace a framework that had been in place since 2006.
Hold on, let's just pause there. 2006.
Yes.
That is 20 years ago. In tech years, that's basically a century.
It's an eternity.
So why has it taken 2 decades to update the rulebook?
Yeah.
And more importantly, why now? Why does it matter today?
Well, you have to think about what the market looked like back in 2006. It was largely paper-based, it was manual,
Right.
and it was driven by a handful of legacy companies. The rules were written for that world.
So they were rigid.
Incredibly rigid, often ambiguous, especially when it came to things like digital reporting, and frankly, they just didn't account for the speed of modern capital.
So the old rules were like trying to run a Tesla on a steam engine track. Is that a fair analogy?
That's a pretty good one, actually, yeah. The new rules, they apply to everything, applications for listings, submissions, filings, and all the continuing obligations.
It was a complete overhaul.
It is a total overhaul. The GSE has already said they're planning engagement sessions to guide market participants and issuers because this is a culture shift, it's not just a policy shift.
But is this just bureaucracy? I mean, regulators love to write new rules. Is this actually going to change anything for an investor, or is it just more paperwork for the CFO?
That's the cynical view, and it's a valid question to ask. But you have to look at the timing. Why February 2026? It's because of what happened in 2025.
Ah, okay.
We have to talk about the bull run.
Right. If you missed this, you were sleeping under a rock.
Okay.
The GSE ended 2025 as the second best performing stock exchange in all of Africa.
And the numbers, they're just staggering. The year-to-date return was 137.40%.
Okay, stop right there. 137%.
Yes.
When I hear a number like that in a frontier market, my alarm bells start going off immediately. Usually that just means inflation was 130%, so your real return was, basically zero.
Yeah.
Is this 137% real money?
That is the crucial distinction. That 137.4% return was in dollar terms.
In dollar terms?
Yes. Even after you account for currency fluctuations, if you had put $1,000 into the GSE index at the start of 2025,
Okay.
you'd have over $2,300 by the end of the year. That is world-class performance, period. Market capitalization rose by 54.50%, jumping from about GH 111 billion to GH 172 billion.
That is massive, massive wealth creation. But let's play devil's advocate for a second. High returns attract attention.
They do.
And they attract sharks. Is updating the rules now a kind of defense mechanism?
It's not just defense. I'd say it's more about maturation. You don't hit 137% returns without attracting international institutional scrutiny.
Of course.
Hedge funds in London and New York are looking at those numbers, but those guys, they don't invest in Wild West markets. They can't.
They need governance.
They need governance. They need transparency. They need to know that the financial reports they are reading meet global standards.
So the 2006 rules were basically scaring them off.
They were certainly a bottleneck. They signaled frontier market. The new rules, they signal emerging market. It's a very deliberate bid to lock in those gains and to prove that the 2025 run wasn't just a fluke.
And we are already seeing signs that it's working. I mean, the sidebar in our notes here mentions First Atlantic Bank listing recently.
Exactly.
That suggests that companies are actually queuing up to join the exchange. They see the opportunity.
They do. And look, increased compliance might temporarily slow down new listings because, well, it's harder to clear the bar now.
Higher bar to entry.
But ultimately, that attracts higher quality issuers. You want companies that can survive a Metis decision stress test, not companies that are just looking for a quick cash grab.
Fair enough. So the public market, the stock exchange, is booming, and it's cleaning up its act. That's the high-grade part of our story today.
Yeah, it's narrative A.
But now we have to turn to the high-stakes structural issues. And this brings us to news item number 2, the push for a Limited Partnerships Act.
This is where we really see the disconnect. The public market is flying, but the private market, specifically venture capital, VC, and private equity, PE, is bleeding.
Leading capital.
Yes. The headline is that Ghana is losing long-term investment capital because we simply do not have a limited partnerships law.
This insight comes from Ama Gyampo, who's the CEO of the Ghana Venture Capital and Private Equity Association, the GVCA. She's been very vocal about this.
Yes.
But I want to unpack this for the listener who isn't a corporate lawyer. Why does the form of the company matter so much? Why can't a VC fund just, register as a normal company under the Companies Act and start investing?
That is the multi-million-dollar question, isn't it? To understand this, you have to understand the difference between a fortress and a pipeline.
Okay, I like analogies. Break that down for me.
Okay, so the Standard Companies Act, which governs most businesses in Ghana, it's designed to build a fortress.
A fortress.
It creates a legal entity that protects the assets inside. It's designed to keep capital in the company to protect creditors. I mean, if you run a factory, you don't want the owners raiding the cash register every Friday, right?
Right, of course not. You need stability. You need that capital to stay put.
Exactly. But a private equity fund is not a factory. It is a pipeline.
A pipeline, okay.
Investors pour money in at the top. The fund manager invests it in various startups. 5-7 years later, they sell the startup. And the money needs to flow back out to the investors, and it needs to flow out immediately.
And the Companies Act, the Fortress Law,
yeah,
it blocks that flow.
It makes it incredibly difficult. Under the current Companies Act, returning capital to your investors usually requires really complex solvency tests, court approvals, or in some cases, even winding up the company entirely.
Yeah.
It's slow, it's expensive, and it's legally very risky.
I see. So if I'm an investor, I'm thinking, okay, I can put my money in, but good luck getting it back out.
Precisely. And that's before we even get to the tax issue. In a standard company, the company pays tax on its profits.
Right.
And then the shareholders pay tax on the dividends they receive. That's double taxation. In a limited partnership, which is the global standard for PE and VC funds, the fund itself is tax transparent. The fund doesn't pay tax. The liability passes through directly to the individual partners.
So because we don't have this pipeline structure legally recognized here in Ghana, what's the consequence? What happens?
Capital flight. It's that simple. Amagampo points out that funds are being domiciled in Mauritius, South Africa, and Nigeria
I hear Mauritius all the time when it comes to this stuff.
because they have the law.
Right.
So you end up with a fund that might be investing in Ghanaian startups using Ghanaian talent, but the legal headquarters is in Port Louis.
And that means all the fees for the lawyers, the accountants, the fund administrators, all those high-paying professional service jobs, they go to Mauritius.
Exactly. Ghana gets the investment, sure, but we lose the entire ecosystem that should be growing around it.
And we lose the tax revenue on all those services.
Well, lose tax revenue and we lose control. It's a huge structural mismatch. The GVCA is lobbying the Office of the President and the Ministry of Finance to fix this.
It just seems like such low-hanging fruit.
It really does. If you pass the law, you stop the bleeding immediately. You repatriate that ecosystem.
And it connects right back to the stock exchange, doesn't it? It has to.
It's the feeder system. It's the beginning of the whole chain. Private equity builds the companies that eventually list on the stock exchange.
Right, the IPO pipeline.
Exactly. If you choke the private equity sector with bad laws, 5 or 10 years from now, the Ghana Stock Exchange runs out of new companies to list. You simply cannot have a healthy public market without a healthy private market fueling it.
So we have a booming stock market, but a broken pipeline for new companies.
No.
Okay. Let's zoom out now to the broader economy. News item number 3. The 2026 economic growth projections.
The number on the table is 4.8%. Ghana is eyeing 4.8% GDP growth in 2026. This comes from EM Advisory.
4.8%. Is that good? I feel like in the heyday, pre-crisis, we were talking about 7-8%. But compared to the last few years, 4.8% sounds, well, stable.
It is a healthy baseline. It's not tiger economy explosion growth, but it's solid, consistent recovery.
Yeah.
What I think is more interesting than the number itself, though, is where that growth is coming from.
The report mentions the drivers are primarily the services sector and commodity gains.
Right. And commodities, gold, oil, cocoa, that's the old Ghana narrative.
Yeah.
Dig it up, ship it out.
The classic story.
But the fact that the services sector, and specifically tourism and the creative arts, is being highlighted as a primary driver, that is significant.
It suggests diversification. It means we're selling value, selling experiences, not just raw materials.
Exactly. For an investor, this signals a major pivot. If you're looking at where to deploy capital, the growth isn't just in the mines anymore. It's in the hotels, the tech services, the creative economy.
However, there is a catch. There's always a catch, isn't there? The headlines all mention that this 4.8% is contingent on fiscal discipline.
And that is the big code word for government. Please stop spending money you don't have. 4.8% assumes the government sticks to its budget. If they go on a spending spree, if they blow the budget, then inflation spikes, interest rates rise, and that growth just evaporates.
Which is the perfect segue to the thief that steals growth in the night. Let's talk about news item number 4, the inflation outlook for 2026.
This is the reality check. EM Advisory predicts that inflation will rise to 11.3% by year-end 2026.
Now, context is really key here. We're doing better than that just recently, weren't we?
We were, yes. In December of 2025, labor inflation had actually fallen to 10.7%, and construction inflation, which is a huge component of the overall basket, had dropped all the way to 4.4%.
So we were seeing single digits on the horizon. It felt possible.
It did. So predicting a rise back up to 11.3%, that's a reversal of the trend. It's a worrying sign.
It is. It means the cost of living crisis isn't a past tense event. It's not over.
It's a chronic condition. For the average consumer, this is just exhausted resignation. It means prices are going to keep ticking up by double digits.
And for the investor, let's connect this back to the stock exchange again. That 137% return.
Well, it becomes the hurdle rate. If you had an amazing year like 2025, you're fine. But in a normal year, if you're a conservative investor buying treasury bills, Your real return is the interest rate minus inflation.
So you need to clear 11.3% just to break even in real terms.
Exactly. You need your investments to be paying at least 15–16% just to make a tiny profit in real terms. It really puts pressure on asset performance.
It puts pressure on the central bank too.
Huge pressure. On one hand, they want to cut rates to stimulate that 4.8% growth we just talked about.
Make it cheaper to borrow and invest.
Right. But they can't cut rates aggressively if inflation is rising back up. They'd just be pouring fuel on the fire. They're stuck between a rock and a hard place.
And usually when inflation rises, the currency suffers, which is news item number 5, the CD performance.
The forecast here is for modest appreciation in 2026.
Modest. That's a politician's word if I've ever heard one. What does modest actually mean to a guy importing spare parts in a Bossy OK?
It means the price of his goods will go up, but it won't double overnight. And look, after the historic volatility we've seen in previous years, modest is actually a relief.
That's a great point.
Business hates volatility more than it hates high prices.
Explain that. Why is a slow, predictable slide better than a wild crash?
Well, think about it. If I'm an importer and I know the CD will depreciate by, say, 5% this year, I can price that into my goods. I can hedge my currency exposure. I can plan.
You can build a strategy around it.
You can, but if it depreciates 20% in January and then appreciates 10% in February, I have absolutely no idea how to price my inventory. I could be selling at a massive loss without even knowing it.
So stability, even if it's stability in a slow decline, it allows for better business strategy.
Exactly. And it does help with export competitiveness, which is the upside. If the CD is slightly weaker, our cocoa and our tourism become cheaper for foreigners with dollars or euros.
But it hurts the government's balance sheet.
It does, because they have to pay back their dollar-denominated loans with weaker CDs. So the debt service burden goes up. It's a trade-off.
Okay, so we have the landscape. 4.8% growth, 11.3% inflation, a modest currency slide. And into this mix, the government is about to drop a bomb. A money bomb.
That's one way to put it.
News item number 6, the Big Push Infrastructure Program.
This is the headline grabber. The launch of a $30 billion Big Push program to strengthen infrastructure in 2026.
30 billion CDs. Let's just try to visualize that. That is a colossal amount of money.
It is. It's a massive capital injection into the physical veins and arteries of the economy. We're talking roads, bridges, energy, digital infrastructure.
But wait a minute. We just talked about fiscal discipline being the absolute key to growth. How does spending $30 billion fit with discipline? Where is this money coming from?
That is the fiscal risk. That's the question every investor is asking. They'll be watching the deficit like hawks. If this is all borrowed money at high domestic interest rates, it could crowd out the private sector.
Meaning the banks will just lend to the safe government instead of to businesses.
Precisely. It could stifle the very growth it's meant to encourage.
However, there is a strategic angle here regarding the timing. Remember what you said earlier about construction inflation?
Yes. This is the clever part. If it's intentional, construction inflation, as we noted, dropped all the way to 4.4% in late 2025.
So the price of cement, steel, and labor is relatively low and stable right now.
Exactly. So if you are going to build a lot of things, now is the time to do it. Your money goes further.
So the $30 billion buys you a lot more road, a lot more bridge today than it would have 2 years ago when construction inflation was over 40%.
It's a buy low strategy for national assets. It's fiscally prudent from that perspective.
And it feeds directly into the growth story. Infrastructure creates jobs.
It's incredibly labor intensive. You need bodies on the ground. You need engineers. You need surveyors. This creates immediate income for households.
And in the long run?
In the long run, better infrastructure supports that services sector growth we talked about. Tourists need good roads to get to the resorts. Farmers need good roads to get their produce to the markets.
Synergy. I like it. But, and this is a massive, massive but, you can pave every single road in the country, but if the people walking on them are starving, what have you actually achieved?
And that's the question.
This brings us to news item number 7. And frankly, this one it hurts to read.
This is the reality check that stops the celebration cold. National food insecurity has hit 38.1%.
This data is fresh. It was released in February 2026, but it covers the third quarter of 2025. It comes from the Ghana Statistical Service and Dr. Alassane Idrisu. 38.1%.
That's more than 1 in every 3 people.
It equates to over 13 million people facing hunger risks. 13 million.
And the trend line is the really scary part. It rose from 35.3% in early 2024. It peaked at over 41%, and now it's settled here at 38.1. This isn't a seasonal blip because of bad rain.
This is structural. This is becoming entrenched.
It is. And the report breaks down who is most at risk.
Let's go through that. The demographic split is stark. If you have no formal education, your chance of being food insecure is 50%.
50%, a coin toss.
Right.
But if you have tertiary education, that drops to 15%.
A huge gap. And regionally, Upper West, Northeast, and Volta regions are the highest risk areas.
While Odi and Greater Accra are the lowest, though still with significant pockets of insecurity.
The report also mentions something called the triple burden. Can you explain that? Because it sounds absolutely terrifying.
It is terrifying. It refers to a specific and growing demographic of people who are facing three crises simultaneously: food insecurity, multidimensional poverty, and unemployment.
So let's be clear. You have no job. You are poor by every metric. Not just income, but housing, water, electricity, education, and on top of that, you have no food.
Exactly. It's a vortex. And the data shows that nearly 20,000 additional people fell into this specific triple burden category in just one quarter.
It's a trap. I mean, how do you even begin to look for a job if you're too hungry to walk to the interview? How do you feed yourself if you have no income?
You can't. It's a cycle that's almost impossible to break without intervention.
Dr. Idrisu made a point in the report that I want to highlight for our business audience because it's so important. He said, and I'm quoting, "Food insecurity is not just a social issue. It affects household welfare, labor productivity, and business confidence."
That is the direct link to the boardroom. We just spent all this time talking about aiming for 4.8% GDP growth. But economic growth is produced by people. It's produced by labor.
And if 38% of your potential workforce is food insecure, their cognitive function is lower. Their physical energy is lower. They're stressed. They're sick more often.
Precisely. You cannot sustain a high-growth economy on an empty stomach. It's impossible. Your national productivity will lag. If you are a CEO, this isn't just a charity issue or a CSR report line item. It's a P&L issue. Your workforce is structurally weakened from the ground up.
And it loops right back into inflation, doesn't it?
It's a vicious cycle. High food insecurity usually means there are supply shortages or distribution problems.
Which drives up food prices.
Exactly. And higher food prices are a major driver of that overall 11.3% inflation outlook we discussed in item 4.
And then the higher inflation makes the food even harder for people to afford.
The cycle just feeds on itself. It spirals.
It's all connected. You can't separate the stock market from the supermarket.
You really, really can't.
So we've covered the 7 items. We have the booming GSE, the missing LP law for private equity, the growth targets, the sticky inflation, the CD slow slide, the massive infrastructure spend, and this devastating food crisis. How do we bring this all together? What is the synthesis here?
The synthesis is that we are looking at a divergent Ghana. We have narrative A and narrative B running in parallel, and they're moving in opposite directions.
Narrative A is the bullish case, the one you tell the foreign investors.
Right. Best performing stock market in Africa. New modern listing rules showing maturity. 4.8% growth being led by services, not just commodities. A massive infrastructure push. If you look at Ghana through that lens, you say buy.
And narrative B is the bearish, the structural case.
Yeah.
The one that keeps you up at night.
That's the one. We have a legal vacuum that is actively chasing away private capital. We have persistent double-digit inflation eating away at returns. And most critically, we have a profound human capital crisis with food security that threatens the very stability of the nation.
So what's the solution? What's the so what for the people listening, the regulators, the business owners?
The so what is that governance and risk management are the only things that can bridge this gap between the two narratives.
Which brings us right back to our sponsor's wheelhouse, the Metis decisions angle.
It does, perfectly. Regulators like the GSE are doing their part. They're improving governance to lock in the wins from 2025. That's good risk management.
But it's not enough.
Not nearly enough. The legislature needs to step up and pass the LP Act to fix the capital flight. That's a governance failure that needs to be corrected. And social policy needs to aggressively, and I mean aggressively, address the food crisis to de-risk the entire macro outlook.
Because you cannot build a first world economy on a third world nutritional baseline. It's just not possible.
You can't. It's a house of cards. The foundation is weak.
I want to leave the listener with a final thought, a provocation to chew on for the week. We have this GH30 billion big push in infrastructure, And we have this deep food crisis.
The race between concrete and calories.
Exactly, that's it. Can that infrastructure push actually help solve the food security crisis? Can better roads to markets lower food prices and save the day?
That's the optimistic view.
Or will the sheer scale of that spending, that $30 billion injection, generate the very inflation that makes food even harder for those 13 million people to afford?
That is the defining question of 2026, isn't it? Will the cure kill the patient, or will it save him?
We'll have to watch and see. This has been the Yildera News Review Analysis. A huge thank you to our sponsor, Medicis Decisions Limited.
If you are trying to navigate this divergent, high-stakes landscape, you really do need a guide.
Go to medisdecisions.com for strategy and governance consulting.
Thank you for listening. We will be back next week to see if the dots have connected any further or if they've drifted even farther apart.
Stay informed, stay strategic, and good luck out there. Goodbye.